Sunday Night Futures Live. How's the audio? Audio good? I'm not on mute. And we'll wait for a few people to pile in here. If you could just give me an audio check, I'd appreciate that. And what we're going to be talking about tonight is how are we going to finish off the year? Where are we going from here? And of course, where do we? Hey, Bob, let me make sure my audio is good. Okay, Lewis, thank you. Hey, Bob, is there any way that you can move your headshot? I got to be honest with you. I canceled this. I'm going to show you exactly what I use. Here is my software that allows me to simulcast to multiple platforms. You could see up here right now we're on Twitch, we're on Twitter. I used to be on Facebook. I got to reconnect that. And one of my big peeves is the fact that I cannot move that that headshot. I contacted them. It seems should be pretty simple to do, but the answer to your question is no. They can't do it. It drives me crazy. So I feel your pain. Let me try it now. No, I just dragged it, and what did it do? It just knocked me off. Let's reshare here. I need a haircut so bad. All right. Lewis, hello. Thank you. Tim, thank you. Frankly, and hope everyone enjoyed a great thing. Yeah, same to you. Thank you for reminding me. I hope everybody had an awesome Thanksgiving. Mine was really good and effective. Effective, I guess tomorrow because I just ate nachos. I gotta drop down weight whenever I feel like the weight come around here. That's when I know I got to get back into the gym and do my thing. And I'm walking around by and large without a crutch. I haven't used a crutch, well, not a crutch, a cane all day today. So got to get back in the gym full time. Pete, hello. Um, Trader Isaac, hello, Trader Isaac. Jeff, I liked your gaso analysis this weekend. Thank you. Yeah, I think that's it's important. Even if you take a look at the chart of home heating oil, it's weakening up along with oil, and the markets right now. I'm taking a look at the markets out of the corner of my eye, and they're not liking um, something right now. It's probably has to do with China. So we're going to go to the futures in the moment. Liz, hey Bob, Tim, always a gentleman. Happy Sunday to you, my friend. Okay, let's talk a little bit about the futures action. We have the Nasdaq on top. These are 15-minute charts. I know my head is blocking the lower box, but this is the VIX. But if I shut off my image, the sound goes out as well. Another reason why I canceled out the service. So I'll have to find a new one. But the VIX is up over a half percentage point. NASDAQ down about a half percentage point. We were lower. We bounced back a little bit. Dollar moving up higher after a bloodbath on the week. Yields are flat versus Friday's close. So it's thin trade here. We don't want to read a whole lot into it, but what I want to do is I want to point out that what this support level, this is the higher level view chart of the NASDAQ we were just looking at. Now it's a 4-hour chart. This was pretty significant support, which has now become resistance. I don't know what the heck just happened. This has never happened to me before. All right, let's move on to the Dow. The Dow, this is a 4-hour chart, but new session, 4-hour lower lows, 15-minute view. The Dow is down 0.18%. Not horrible, certainly doing less worse than the NASDAQ. Sticking with equities, let's take a look at the RUT 2000, down over a quarter of a percentage point. And capping it off with my S&Ps. Where are my S&Ps? Okay, so S&Ps are down on the session. They're coming off their lows now, down just over at nearly a third of a percentage point. Okay, so if we have time later on, we'll come back. We'll take a look at equities and see how they wash out. It's very thin volume right now. We don't want to read too much into this. Now, if we start breaking down to new lower lows on the session, then it becomes a bit more concerning. Right now, all we're focused on is maintaining session lows. Ugh, I always do that. Always do that. At or below. At or below. Okay. So that's it for equities. We're beginning the week off fairly light. I'm not all that concerned about it. Let's move on to the dollar. The dollar is gapping up. That's certainly not going to help equities at all. Let's see what's helping drive the dollar up. The dollar did bounce off of weekly support last week. So to see a continuation pop up higher here, no great shock. Euro is down. That's driving the dollar up. Yen is probably down as well. It is. And that's driving the dollar up. So these aren't huge moves. I'm not all that worried, but I'm sure it's probably going to have a bit of a negative impact. What the hell? On gold, but apparently not. We're gapping up here. We closed at 1678.80 the ounce on gold. We hit a session high this evening of 1771 on a gapping US dollar. That's pretty odd. Usually when you see that, you get a correlation of the dollar and gold. It usually means some sort of geopolitical risk or fear is on the table. Let's see whether or not this holds up. It won't last. One of the two is gonna break. Could be today, could be tomorrow, could be 2 weeks from now. But this correlation is not going to last. Historically, it never does. Let's move on to silver. Silver gapping up, big move here. And we're going to be talking about silver and gold in a little while and why, even with this gap up, it's really time, folks. If you're not in it, in gold, in silver, as we are, in the mining stocks as we are, you need to be. If you want to know when we're adding more, join our 14-day free trial offer. We send out alerts to our members. So silver gapping up higher here in the face of a US dollar. That's pretty bullish stuff. Let's check in with other commodities such as energy, nat gas. There is a polar vortex moving in to the into North America, and that's being reflected here on nat gas. It had a big move lower, about 6% lower on Friday, and it looks as though we are really recapturing all those losses in one 30-minute candle on nat gas. We're long of nat gas. So very bullish price action here for natural gas. Let's take a look at oil. Oil broke down about 2 weeks ago. It had a continuation breakdown. Last week was my light sweet crude. Light sweet crude is down. New weekly lower low. Let me make sure that's right. No, I stand corrected. I am inaccurate. The last low was on the 21st. Was that last week? I believe it was. Yes, last Monday. So no new weekly low. I stand corrected. Fact checkers need not correct me. What else do we have here? Let's take a look at agriculture names. For agriculture names, I like to go to the weekly chart. We don't track them day by day. So the higher level view of names like wheat, wheat is very weak. So, you take a look at the agriculture space along with energy prices, and what is happening is that you're seeing prices come down. We don't wait for economic data here. What we do, and this is why we get together, and you're wise enough to spend a little bit of time with us on Sunday nights and Thursday nights live when we go over these charts and we're saying, okay, uh, do we have inflationary forces that are still uh, pressuring the Federal Reserve to hike as aggressively as they might have? And the answer, when it comes down to energy, is clearly energy prices are coming down, whether it be home heating oil. It's still up 60% year over year, and that's still a lot of inflation. But the trend is beginning to tick down. And you may be saying, Bob, wait a minute, the Federal Reserve backs out food and energy out of their core CPI data or core PCE data. And you're accurate. But don't forget, a lot of input costs into industrial names that are in that core CPI, well, those input costs are derivatives of refined oil products. They're still in the mix. So the cost of production is brought down when oil prices come down. That impacts the core. So it's good to see that we're seeing a move lower. This is a weekly chart, not reflective of today's price action yet. So a very bearish week on wheat prices last week. Corn prices, they stabilize. Clearly, we may have a higher low here. What are we doing? There we go. So let's see if we hold this wedge formation. Soybeans, a very important crop, holding support, but it's not going anywhere. So the rate of change, the rate of inflationary pressure is clearly dropped off in particular energy, and no doubt in food prices as well. And the last I looked, and we haven't gone over cattle prices or hog prices in a while. Those protein prices, anybody like me that likes a good steak or some baby back ribs, you're worried about protein prices, and even protein prices. These are lean hogs. These prices are coming off their peak. As for cattle, we may have a lower high here. And last week, a breakout was rejected. And it looks as though we may move lower on cattle prices, which again is very, very bullish for equities. And the reason is that, again, right now you had the Fed minutes. They came out last week. The narrative that the market is selling to the public, selling to institutional viewers, is that the Federal Reserve, vis-a-vis their divining of what the minutes stated, will only increase rates by a half percentage point in December. That's really the last obstacle that we have for the calendar year. So as long as these prices continue to trend lower, let's check back in with equities. NASDAQ coming off of its lows. VIX, I know you can't see it there. VIX, let me bring the VIX up here. What's the symbol? I thought it was, could be VXX. Where is it? As a matter of fact, oh, VX. There we go. So this is a 15-minute view. Let's pull back, smooth it out a little bit. 30-minute view of volatility. And volatility did come in quite a bit these past few weeks. It did hit a support level. So this chart may cause a bit of problems this week. If not this week, perhaps into the first 2 full calendar weeks of December. We begin December on, I believe, Thursday is the first. Four-hour view. Yeah. So here's our trading range on the VIX. Let's get rid of this. And we're looking for a breakout here. Here's our trading range. Let's go to some comments. Hey, Paul, welcome, my friend. Pete, do you watch gold silver ratio and buy accordingly? I check in on it from time to time. I kind of stopped doing it because silver has been so undervalued relative to gold for so long. I just still go by that assumption, and I believe it still is. Correct me if I'm wrong, but I like both. But I am probably going to be buying some physical silver if, in fact, that ratio is still in place. Tal, and same to you, my friend. Happy Thanksgiving. Pete, the gentleman. TF Hatter, welcome. Railroad strike potential still on the table. Yes, good point. TZ Burton, welcome, my friend. Stop rate on NG on Friday due to weather forecast. Yeah, I think that's what's driving it up. But natural gas is very sensitive to weather reports. Anyone else see the retweet from Jordan Peterson on Earth getting greener due to more CO2? No, no. Along SQQQ and UVXY. I don't know, Talon. Good luck with it. The UVXY I'm probably more favorable towards for short-term trade. SQQQ, be careful with that. The TQQQ or QQQ broke out 2 weeks ago, held support last week to close up. So, we go by probabilities here, and the probabilities are that, in all probability, we're gonna move up higher. So we'll talk about it more in a moment. So just be careful with that trade. I won't argue with the trade in a few weeks, though, because we'll be going over some reasons as to why we're very, very concerned about this market going into 2023, and we will be looking to load up on short names. So, the first topic we want to talk about today is market positioning and drivers. Will there be an everything rally, or will stocks risk off into the year end? I've been of the mind of the past several weeks, even when the market was moving lower, I said expect a rally. And sure enough, we got the rally. And do I think that we're probably going to move up higher? Yes, I do. I think that we will. I think that we're probably going to have some chop the first 2 weeks of the first 2 weeks of December, and we'll go to seasonality just to remind everyone where we stand in terms of monthly seasonality. S&P 500. This goes back 30 years. November up 69% of the time. Clearly the best month out of the year, whereas December comes in around, I was surprised about this, around fourth in terms of the best performing month. So still favorable, up 68% of the times. So odds favor bulls going into the back half of November and into December. The story changes a bit when you do a deeper dive and you go down to a weekly chart, and you can see that the week that we're going into is up 72% of the time. That's good stuff. That drops down pretty dramatically. The first full and second weeks of December. The final week of December is usually an up week, very, very thin volume. The powers that be put their computers on autopilot, keep the market in check, bias to the upside, and they head off on their Learjets over to Stad and Aspen. You know, they don't want to be bothered with the stock market crash. Because so generally that's what happens. The a couple of weeks in December where you see downward moving could be tax loss selling. Probably going to be a lot of that this year. So expect names like the ARK Fund. If they get beaten up in those 2 weeks, I think that they're probably going to see a rally, a short squeeze rally into the back half of the year. We'll be watching out for them. So I mentioned earlier that, oh, by the way, if you like these seasonality graphs, TrendSpider 35% discount code below. So we had the Fed meeting Fed minutes released last week on the 23rd. And the expectation is that they're going to raise rates. They're going to meet on December the 14th. Oddly enough, when is December the 14th? Or not so oddly enough, right where you see the volatility in the markets on seasonality. Back to our regularly scheduled show here. So the expectation is for a half basis point rate hike. So we've had what, three quarter basis point moves higher from the Federal Reserve. That's a massive, massive move. So I think that the markets will be like, thank you, daddy, if we only get a half basis point move up higher. The problem comes in is if we get economic data that comes out this week or between now and the Fed meeting that implies that, you know what, inflation is not as tame as Bob Desmond over the Contrarian Trader is saying that it is. It's not coming down possibly as noted by the economic reports. Well, I'll give you a flip side to that. What if the economic data comes out weak on the jobs front? What position is the Federal Reserve backed into in that situation? So the next week in this trading week is going to be chock full of economic data like you haven't seen in a long, long time. And I'm just going to blow through it really, really quick. I had this highlighted. What do they do in my highlights? There we go. On Monday, not much happening. You're going to get some Fed heads out. Tuesday, S&P Case-Shiller U.S. Home Price Index. That's expected to drop. The previous read was a negative 9.8%. You're seeing pockets of the U.S. housing market come in as interest rates have moved up higher. Same day on the 29th, we get U.S. Consumer Confidence Index. It is expected that That is not going to be a good number. Consumer confidence is hurting. The 30th brings with it the precursor to the pimp Mac Daddy of all economic reports. That is non-farm payrolls. But first, we get the ADP, their new uh, model of how they determine unemployment, and they're expecting a 200,000 job creation expectation. That's down from the previous month. I don't know if this is seasonally adjusted or not, so don't read too much into these numbers. But 239,000, the prior number, they're expecting lower than that in this new read. And I think that this is a problem because I would think that in November, going into December, you're seeing holiday hirings pick up. And I would expect to see that in this number. And apparently, they're not expecting to see that. We're going to get real GDP. This is the revision for Q3. Remember, that came out positive. Let's see if they ratchet that down. Job openings, important number, and jobs quits. Now, quits is what it means. How many people are quitting their jobs? So if you're seeing job quits lighten up, believe it or not, that takes pressure off the Federal Reserve. Why? It's because companies don't have to hire additional compensation to keep their employees on. They can go back to abusing them like they traditionally would. So job openings will be important as well. Then on Thursday, you get the Fed's favorite inflation read, and that is the PCE price index. That's their favorite inflation model. Not highlighted, but important, the ISM manufacturing index. Any read above 50 is a sign of expansion, folks. The services ISM went negative months ago. They're hoping for 50%, which still signals some expansion, but we are holding on by a very, very thin thread. Construction spending, they're expecting a slight gain. And then, of course, on Friday, this is when the market could either implode or explode. Why? Non-farm payrolls. Watch this number. Very, very important. If it comes in weak, that means that the Federal Reserve is going to have a problem with being so aggressive with their tightening. Also, average hourly earnings. As sick and perverse as it is, Wall Street likes less wages, and so does the Federal Reserve. So if you see weakness in average hourly earnings to the markets, that is a good thing. Don't go knee-jerk reactions selling on non-farm payrolls being weak or average hourly earnings being weak. The markets want to see that because that will influence whether or not they will go through with a half basis point move. However, if these numbers come out too strong, guess what? Their narrative may change from, okay, we're expecting a half basis point move that'll send stocks up into the back half of the year, to now we're going back to an expectation of a 3/4 basis point move. That will definitely act as a headwind for equities. Taking a look at the market is expensive, folks. These are the valuations. We go over this every week. We are more expensive this week than we were last week. And I'm sorry, we haven't had a real washout in valuations in, I don't know, when we down at 16.99 the last time. I mean, that was around 2000. That was around the financial crisis. It's been a long time. So the mean is around 17. We're at 29.5, right? So we're about a third expensive right now. 30% overvalued. The 33% overvalued. I'll get it eventually. All right, the Buffett indicator says fairly valued. Don't read too much into that. As I just mentioned, we're approximately 30% overvalued or extended beyond historical trend. So If people say, wow, the stock market was down this year so much, we need to start buying stocks, remind them they are not cheap. Earnings have come in, forward-looking guidance has come in. So stocks are not expected to be cheaper next quarter. They could quite possibly be more expensive. Threats to the market, these lockdown policies over in China could definitely be a problem for the markets. That could be why the markets are down in the pre-market. Long shot. One thing I found amusing is that the Europeans are finally waking up, and this could actually be a good thing for the economy. EU accuses Washington of making a fortune from the Ukraine war. Folks, we've been long of LNG, that's Cheniere Energy, liquefied natural gas, for quite a while now. And we were long of the call options. We booked profits there. We own the stock. Yeah, we knew this. We knew to look there. We knew that it was going to do well. Now the Europeans, after they put a gun to their own heads, they are now beholden to the United States. And I highlighted this is going to be a problem. This is going to be a change in the narrative. Top European officials are furious with Joe Biden's administration and now accuse the Americans of making a fortune from the war while EU countries suffer. No joke. You didn't see this? I don't blame Biden. I blame the Europeans. They should have known. The country that is most profiting from the war is the U.S. because they are selling more gas. What do we own? Cheniere Energy, liquefied natural gas transporters. We own natural gas. That's not by accident, right? The charts are telling us, the news told us that the wind is at the back of these names. We're not going to sell them anytime soon, as long as their prices remain supportive. And what's natural gas doing to this evening? It's gapping up higher. So shame on them. The United States sells us its gas with a multiplier effect of 4 when it crosses the Atlantic. That's capitalism. You wanted to go and become bourgeois capitalists. You know what? We're still capitalist animals here. So for now, anyway, is Washington still our ally or not? Okay, I think the message is clear. Once they blew up or supposedly blew up those pipelines, meaning either us or the British, we're the only ones capable of doing it. That's a declaration of war. Those are German pipelines. The Russians built them. Those are German pipelines. More evidence of inflation coming in. The diesel crunch is finally causing demand destruction. So diesel prices finally starting to see less demand. With that comes less pricing power. Oil market metrics signals sufficient supply and weakening demand. Again, demand destruction. This is exactly what Powell wanted, and he's getting it. What are the other threats? And I want to segue now. These are basically the reasons as to why I believe that going into the back half of the year and possibly even the first 2 weeks of the new year, because you're going to have people that do tax loss selling in December, and then they're going to buy them back after the 30-day mark in the first couple of weeks of January. It happens. So after that, we have problems. We have a lot of problems out there. And one of them for 2023, I don't know if anybody's realized this, but we've spoken about this for months now. We warned about it being in concept phase, and now I'm here to tell you, and I'm not happy to say it, it has been launched. The New York Fed launches a 12-week CBDC pilot program. Folks, this is the Fedcoin. This is the digital dollar. This is programmable money. There is not one single benefit to the U.S. consumer by having this project out there. It's great for institutions if this pilot works out. They increase settlement time, less fees, blah, 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 blah. It's great for them. There is not one bit of upside for you and me, the taxpayer. All we have are downside. Why? Because the money is centralized with the Federal Reserve. They issue it. They track every single transaction, and they could say, listen, you bought too many carbon related objects last month. Therefore, we're limiting you in terms of your gas expenditures going into this month. This is negative projection. But the reason there's negative projections is because we've already seen this happen in Canada. We've seen it happen in China. You've had Klaus Schwab from the World Economic Forum come out. So he took the mask off. He says, that's the model that we want to follow, the Chinese model. And what do they have there? Digital currency. You cannot use cash, I don't believe, correct me if I'm wrong, in China any longer. And look at how they're doing. So this may not be a 2023 thing, but it's coming. Sure as God made green little apples. What is unknown and what is happening here, and I'm going to go into this right off the cuff, and I have been steadfast. I have not moved off of this one single time. And that's the fact that I do not believe that we have seen the bottom, despite what I've been saying the entire program, that I think this market is going up higher. Why? Why am I so bullish short term, bearish longer term? Well, short term, you have seasonality and you still have a lot of oversold stocks. The ARC names are oversold. While you could still see some tax loss selling there, I think that you're going to see a continued rally in perhaps not the Dow names and many of the S&P names because they've hit resistance levels. What hasn't really taken off yet are the trip Qs. And you have a lot of shorts in there waiting to get squeezed. Once they get squeezed out, then they're going to take the ARK names, the ARKK names, the ARKQ names, and they're going to squeeze them up into the new year. After that, I don't know what happens. I'm not that smart. The market's going to tell me. But one thing the market hasn't told me, and that's this. It's that the VIX has not told me that we have seen a blow off top. It hasn't happened. The high of the year on the VIX, $38.94. Keep that in mind. $38.94. Go back in time. And I know that many of you that come here every Sunday night, you hear me talk about this from time to time, and you get tired of hearing it. But for the people that are new, it's valuable. Okay? Go back in time. Pick your bubble. .com crisis. We hit a high on the VIX 45.08. We haven't even hit a 40 handle in 2022 on the VIX. Financial crisis, we hit a high of 89.53. Again, we haven't hit a high of 40. We haven't hit a 40 handle high yet in 2022. COVID, 85.47. 85.47. Again, this year, never a 40 handle. So the VIX is telling me, hey, listen, we're not done yet. We are not done. We have not had the washout necessary to clean out everyone. And when you take a look at a quarterly chart of the VIX, folks, while this quarter thus far, with 1 month left to go, is a brutal, brutal sell-off, no doubt about it. But I want to point out something, and that's this. For those not familiar, these are your stochastics. It's a momentum indicator. Some people use it for overbought, oversold trading. That's not really what I use it for. I look for it as like an early identifier of a trend, a market signal, something that, you know what, it should be doing something, and it's not. It's not validating the price. And when you take a look at this candlestick, you'd expect, you know, well, let me scroll up, take a look at the Stokes. They're probably down as well, probably getting really pressured. But in reality, you know, they're not. They're putting in higher lows. And there's not much reaction here. Yes, RSI is down, but it's still at a respectable around a 50 handle. So not a lot of fear in the fear gauge here in terms of the momentum indicators validating the strength of this pullback. I'm just not seeing it. In fact, you take a look at Ultimate Oscillator, higher lows. This ADX line is just astounding. Any read above 65 on the black signal line on ADX is just like unsustainable overbought levels. And the trend is probably going to reverse. Folks, we're at 75.68. This needs to get resolved, and it hasn't. Add to that, this was a tweet that was posted. I got to give props to people that post good stuff. I follow Michael Gayed, CFA, on Twitter, and he posted this out earlier. I'll drill down here in a moment. Below are the 20 largest drawdowns for the S&P 500 going back to 1961. Good data. Never in history in an extreme drawdown for stocks have treasuries risk off. Usually when you have a risk off environment, money goes into treasuries, gone down more than stocks. Again, never in history in an extreme drawdown for stocks have treasuries gone down more than stocks. Think about it. It is not just a function of Fed hiking rates. It's a family-friendly show. I can't read the rest of this, but wake up. So here's the chart. I mean, I think what's important to put into context here is our current environment. Now, we began the year at a Fed funds rate that was basically zero, right? 0.1. Now we're 3.8% on the Fed funds rate. You can go back to a similar time back here in 1961 and 1962, where we had a Fed funds rate at the start at around a half a percentage point. Not that far off from where we began this year. And we finished off the year at 3%. So a significant move up higher in the Fed's funds rate. But you take a look at the 20-year Treasury bond, it was up 4.5% on the year, while equities were down nearly 27%. Fast forward to this year, equities are down nearly 25%, with bond prices down nearly 27.5%, and they're off their lows. This is the bond market saying there's something very, very wrong out there. Very wrong. We do not want to hold this debt. So what are the catalysts that could send this market down lower in 2023? Let me play this.
The day everybody anticipates, and it's a day that violence can erupt, and it's Black Friday, and that's it. Thanks to Brandon for the inflation and giving us shitty footage on this Black Friday. The day everybody...
Sorry about the foul language. So what he's referring to here is that Black Friday this year was a catastrophe, was an absolute catastrophe. Remember, the U.S. economy is a consumer-driven economy, and the consumer is tapped out. They have to decide. If you take a look at a chart of, here's the XLY for the month. This is the consumer discretionary ETF. Now, it is down about a percentage point on the month, whereas the S&P 500 is up 3.98%. That's roughly a 3% variance. Now, when you take a look at consumer staples on the month, they are breaking out. They are up 4.83%. They're outperforming the S&P 500. So what is in the consumer staples basket? Anything that has to do with your gas tank and food, for the most part, boiled down. And all that money is going here. It is clearly not going here. So why does this matter when we go into, or we're looking at 2023? Well, this is the other chart that, and I've cleaned this up quite a bit because we're going to be using this a lot moving forward. It may look different to those of you that have been watching it, but by and large, it's the same chart, just cleaned up. And I want to point out that this is the yield curve. The yield curve is the yield on the 2-year bond versus the 10-year bond. And when the yield on the 2-year bond pays more than the yield on a 10-year bond, that tells you that institutions don't want to put money to work out 10 years. They don't want to invest in treasuries 10 years out. They'll stay near term. They'll buy short-dated treasuries 1 year, 1 month, 3 month, 2 year. And what happens is that that translates into a yield curve inversion. We go negative. And this has happened many times going back to 1955. And the only time that it did not result in a recession was in 1965. But I just learned this from George Gammon. Credit to George Gammon. He did a video on the yield curve the other day. Very good. George Gammon on YouTube. Highly suggest you watch him. He pointed out that in 1965, the yield curve did invert. However, the U.S. economy still grew slightly. And what was not known until now was that we were growing at around 10.5% in 1965. We finished off the year up only 0.02%, just narrowly missing a recession. But in context, this is our canary in the coal mine for the next bust in the stock market. And you don't need to worry about selling equities when the yield curve is inverting. You need to worry about when it's ripping up higher, because that means that the Federal Reserve is needing to take drastic action by cutting rates aggressively because something broke. Now, you could argue that something has already broken, whether it be our debt, which is unsustainable, whether it be the Federal Reserve having put it put foot on the gas pedal too much in terms of hiking rates, whether it be the consumer now being in very dire straits. Either way, I don't know what is going to be the next cause. I'm not that smart. I have an idea, but I can only guess at this point in time. The dot-com crisis, as you can see back here, resulted in the yield curve steepening. And here in silver or gray, you have the S&P 500, and it went into a decline when you got the steepening. Same here in the financial crisis, steepening, S&P 500 rolled over. I'm going to get to gold in gold color in a moment. I am not looking past that one because we're going to be talking about it in great detail in a moment, because I'm going to be giving you our philosophy on the way we will be trading with a hedge going into 2023. So stick around to the end. Fast forward, COVID, steepening, big sell-off in the stock market. This time around, with the inversion of the yield curve, the stock market has done something that it didn't normally do. It has come down as well. Our stocks front-running the yield curve in expectation of a big bust? Maybe. Is it already a steepening already priced in? Maybe. I need to keep an open mind. I don't know it all. Maybe this is already priced into the steepening of the yield curve. Maybe. But absence the blow-off top on the VIX, which is marked every single top going back to, I don't know, let's call it the dot-com crisis. This, to me, and the VIX remain our canary in the coal mine for the next step in this market. It's probably going to get resolved in 2023. So I skipped over this on purpose so we could segue over into what our plan is for 2023. Now, we already own physical gold. I plan on buying physical silver. We already own electronic silver. We plan on putting on a call hedge of GLD in our portfolio writing account. We have one of our businesses is writing premium and generating cash flow. I want big hedges. That's what 2023 is going to be all about, putting on big hedges. Gold right now is, as you can see here on the yield curve, when it steepens, gold generally rips up higher as stocks tank. It happened here, dot-com bubble. It lasted for a number of years. It happened here, financial crisis, ripped up higher and continued ripping up higher until 2023, 2013. COVID. Gold didn't do as well during that time frame, but it did pretty good. The everything bubble, gold has already started to lift back up. The dollar's starting to come down, gold lifting up. I'm going to leave XOY to the last because that's going to be the second part of our hedge on our options writing business. Because I don't want to wake up one morning and have simply a neutral portfolio that is undefined risk, meaning on a big sell-off in the market, those what appear to be, when I went to sleep the night before, safe bets of undefined risk, all of a sudden are in trouble. I want to have heavy bombers in terms of hedges on to protect that portfolio, even if it's going to cost me a good amount of money to put them on. Because these charts are telling me, if you haven't learned from history, then you have no business being in this business. So since we know that during the steepening of the yield curve, during times of crisis, that gold is moving up higher, I want more gold. I want more gold. So as you can see here, gold is up nearly 7% on the month. So that begs the question, how is it doing relative to the S&P 500? Great question. It's trouncing the S&P 500. The S&P 500 is up less than 4% with gold up just shy of 7%. Trouncing. How about silver? Silver is up over 12% on the month. And it's going higher. They have been beaten up. They are nowhere near their 52-week highs. So if you get no value other than this information right here, right now, please use this as your takeaway. And plus, like, subscribe to the channel if you would. And it helps me out with the YouTube algorithm. So we plan on adding a hedge of GLD, a fairly sizable position, taking advantage of any move higher in gold. We like the trend anyway, so even if an event doesn't happen, we should still profit off of that trade. I will be sending out trade alerts to our members when we accumulate that position. I'm not just going to go running in and buying the entire accumulation in one shot. I'll buy on days of weakness, and we'll take advantage of that weakness because we know the macro trend is higher. And we know that the yield curve, this is unsustainable. What else are we liking here? Silver. We already own it. Buying more. Love the breakout here. Looking really good. So what's our other hedge bet going into 2023? Because I plan on maintaining the options writing business. It's just been too good to us. So we're going to continue doing that. And we send out alerts to members on those trades. But I'm looking at the consumer discretionary names as a short. Would I short them here and now? No, definitely not. Even though they're underperforming the S&P 500 and the consumer staples names, I would not short them now. Unless, of course, we just start rolling over tomorrow and we begin breaking down to new lower lows. Because you may not realize it, but out of all the sectors out there, there is only one sector that I know of. Fact check me on this. The only sector I know, weekly chart, XLP, that I know that is taken out, not just, excuse me, wrong chart, XLY I wanted. XOY, consumer discretionaries, they have taken out not just the October lows, but the June lows as well. They've bounced back along with the rest of the market. But I think that this sector might see a move up higher into the back half of the year on that rally up higher. We're probably going to be looking to short the XLY, and we're going to be using on both the call purchase of GLD and the put purchase of XLY, probably leap options. Leap are very long dated options expiring in, I think that is January of 2025. So we avoid that time decay. That, my friends, is all she wrote for this evening. Let's do some chart requests. Anybody having there? We'll go to comments first. Jody. Hey, Jody. NY has been making horrible decisions all year. No doubt about it. If CBDC comes into play, how will that impact on gold and silver? So, Pete, I think that's a great question. My take of it is this: if they don't eliminate cash, meaning greenbacks, and they're still printing greenbacks, I think they're on life support right now. To be honest with you, I think that the CBDCs, they'll usher them out. People will forget about them. Then they'll do away with cash, and then they will have forgotten about the programmability of money, and that's when they really come back to bite us. That's where I think their game plan is going to be. I haven't listened to anybody on this other than a couple of people. They have really no solution other than hold cash, but I think they're going to do away with cash. So what would I do? If they do away with cash and you have the CBDCs, I'm doing it already. I think that you need to own gold and silver. You have to. Could they outlaw it? Sure. And then you're kind of screwed, and you have to sell it back to the government if you so choose to do so. But they could outlaw the purchases of silver and gold, and that's why you may want to own gold mining stocks. Those are certainly going to be needed. You may want to buy it now, bury it in the ground, hide it. Don't put it in a bank. They could seize or close the banks. So I think that it's going to be bullish for gold and silver. Who the heck is going to want a dollar that they could take away from you, or they could restrict your usage of? I want to have something in my pocket I could pay border guards with. So that's my take on gold and silver and CBDCs. Why are governments listening to the World Economic Forum? The World Economic Forum is backed by billionaires, and those billionaires have paid off politicians. It's as simple as that. It's just simply corruption. And if you want to make the argument that they're able to rig elections now, I mean, the election day is long gone, and we still don't know who the governor of Arizona is. I mean, Brazil is in an uproar right now. You have a president there that has not conceded defeat. The electoral process is a major problem. They seem to have infiltrated governments. And listen, you have Klaus Schwab himself that brags about inflating cabinets and governments. So if they're willing to say it aloud, they have no fear, zero fear. Now, that could be just arrogance and hubris, and maybe it'll come back to bite them. But I see nobody in power talking about them except for Ron DeSantis, to be honest. And I didn't even hear Donald Trump talk about him. I didn't buy anything. My wife shopped today. A lot of bargains today. Yeah, my wife did too. I heard a lot of families didn't even celebrate. Yeah, that's sad. They're having a chew between energy and food. Just thanks for that, TZ Bird. Yeah, what? George Gammon, very, very good. Gammon, I believe, or Gamon, one of the two. XOC took out June lows, but did it take out the October lows? Actually, no, it must have, because, right, the XLC. Okay. Yep, you're right. You are absolutely correct. Thank you for that. I was fact-checked. We only want honesty on this show. XLC also took out the lows. That's the communications services sector. Thank you for that, Jeff. Annalie. Annalie is on our watch list for REITs. For those not familiar, Annalie is a REIT, very volatile, but it does, wrong, sorry about that, NLY. Wow, what a move. It got very extended. I'm picking up on the seasonality chart here. Wow, this is interesting. Oh, it's 50. Why do they have 53 weeks? I guess for leap year or something like that. But the back half of the year really grinds down in terms of seasonality. So just be aware of that. That's 19 years worth of data. It looks good. It looks good. You can sell premium here. I'd be fine with selling puts as long as they're out of the money and they're expensive. It looks as though it wants to go higher. Pretty bullish on it. I just don't like the seasonality is all. And we are trading up and into that third standard deviation Bollinger Band monthly chart, but not too horrible. Daniel DiMartino Booth, love her. I follow her as well on Twitter. So she's watching twos versus tens. Ah, yeah. The junk bonds, yeah. Curve as a leading indicator. No, she's got access to Bloomberg. She's on a different level in terms of access to data. You could just simply take a look at the junk bond market, which on a month, this is the JNK. You can also use HYG. It should look the same. HYG, a little bit more constructive. They're coming off their lows, but certainly they are still in a downtrend. So I definitely would listen to Danielle. She worked in the Federal Reserve for quite a while. EQT for Trader Isaac. Monthly chart, consolidating sideways, uptrend on a, this is a new functionality. If I didn't mention this, it's called fractal. What is it called? I just put this up here the other day. Here it is. Fractal trend lines on TrendSpider, if you're wondering what these are. And these lines are, I got to have a meeting with them to talk more about this. Yeah, this is the average true range. So we're bouncing off of the average true range on EQT. The only concern I have is that we are possibly putting in lower highs. Think about a stop right below. I wouldn't keep it too tight because it'll shake you out. Right below 37.56. But otherwise, looks like it may want to move up higher here. Seasonally, very strong final week of the year. The month of December is pretty much 50-50 up until that final month. So if you get a big dip in early December, you want to buy that dip for the ride up. That's one potential way to trade it. Just know your support levels. And technically, we're at one right now, daily view. We broke out on the 22nd, pullback retested. I would wait for a retest back down at 42.35 and look to add there. That's where you have the breakout point retrace at. BC, it's up here. BCRX. We'll come back to the daily chart. Let's take this off for a moment. Yeah, we're dancing right on top of a VWAP. Not much data here though. Weekly view. We're pretty weak here. We're trading down below. It's weekly VWAP connecting prior lows, and we broke down below it. That's a problem. And when you take a look at a daily chart on Friday, granted Friday was an abbreviated day, but we broke down, and this to me is a classic bear flag setup. So I would avoid BCRX. I think that it's probably going to move lower. So just be careful there. Gammon, Gammon. Thank you. Danny Dimoti, the booth used to be on Patrick David show, but not in a long while. She has her own thing going on. I think it's Quill newsletter. I haven't seen it, but I listen to her on Hedge Eye. She's on Hedge Eye quite a bit. Mosaic. This is one I haven't looked at in a while. Mosaic. This is a daily chart. Holding consolidation here. Mosaic is this the fertilizer company? A lot of overhead supply here at 51.98. Where do we close? 51.70. We're right at resistance. You need to wait for a breakout here. I do think it's going to get resolved to the upside. Again, resistance immediately above. I like the chart, but a lot of sellers immediately above. Franklin, thank you. Have a great night. Talk to you tomorrow. Tim, thank you, sir. Thank you for being here. NEM, Newmont. We'll leave it off with Newmont. Okay. Newmont, it's a gold mining stock. It's top tier, best of breed. Up on the month. Consistent with the other gold mining ETFs, around a little over 6.5%. And I think it's going up higher. We've stopped going down. I think we're lifting up higher. Stokes, higher low now, hooking up. Weekly view. Nice strong move up higher. The 7th, we consolidated. We're holding on top of this Bollinger, the 20-period moving average. I think it goes up higher, especially if the dollar weakens up. Reversal bar down day on Friday, abbreviated day. I'm not even going to read that much into it. Longer term, Newmont Mining, along with the other gold mining stocks, goes up higher. Folks, thanks for being here. Please, if you haven't hit the like button, please like, subscribe, share with a friend, and follow me on YouTube, Twitter. Don't forget about our 14-day free trial offer. And if you're not ready for that yet, that's fine. TrendSpider, 35% discount code below. They have a 7-day free trial offer. We give it away free to 14-day members to the silver and gold level memberships. Everybody have an awesome night. Thank you for being here. Be well.